And good afternoon, everybody. Welcome to this edition of our 2026 Market Outlook. Got lots of information to go through today. I'm joined by Nick Tabor, who has recently passed his CFP exam, so you are officially CFP. Of course, Benjamin Stark and myself, Paul Muller. Jean Reardon is under the weather, as I think most of the area is. She is resting up at home. Does send her best wishes to everybody. So before we get started, lots has happened in the prior year. Any thoughts on 2025 before we dive into 2026?
Mr. New CFP, I'll let you kick that one off.
Yeah, I mean, look, we've been kind of going back to this for the past couple of years, right? We've had some really strong years since really 2022. And it almost seems like the start of the year, we get together and we say, it can't be as good as the last year. But this past year, 2025, I think it exceeded a lot of expectations, a lot of analyst expectations, and ours as well. I mean, the S&P 500 ended up around 18% after two to 3 years of 20% returns in the market. We see this bull run continue, and it's been good to see for portfolios.
Yeah, and I think some of the things that we looked at in 2025, definitely are carrying forward, especially into the beginning of 2026 here. What are some of the highlights that you focus in on from 2025 that were impactful to the market?
I think if I were to summarize it, Paul, I would say 2025 was chaotic, but positive, right? We saw really, I think, that initial blip in the markets with all the media headlines about tariffs and what was going on there. I mean, the market really took somewhat of a nosedive in April, but we saw the market rebound and ultimately do well. And we saw a lot of tax expansions. I think that's not really reflected in the markets yet, but I think over time that will continue to really support the bull market under the One Big Beautiful Bill Act. We're going to see we saw a lot of expansions already take place for 2025 on the SALT caps going from 10,000 to 40,000. So I think we'll continue to see growth in the markets, but I think for 26, which we'll talk about, we'll start to see some slowdowns.
Yep. Awesome. So thanks for that, guys. And for anybody that may have questions, feel free to use the Q&A bar. We'd be happy to go through whatever questions come in. And without any further ado, let's go ahead and get started, guys. So this is really what you sort of alluded to, coming into 2026 is, obviously no different from where we left off in 2025. But, it is about the economy, right? And there was some banter, especially once the tariffs kicked in, about a recession. Thoughts about a recession in 2026?
I think it's going to be low. There's always a chance that something really bad could happen, right? But we've seen the markets just do well. Really, I think the biggest conversation point around that, Paul, is inflation has been persistent, and we've seen the softening of the labor market. And that's really where I think the recession concerns are stemming from, not really so much about tariffs and other things of that nature. But I actually think the cooling of the labor market will, and I know there's a chart coming up showing where inflation is at. I think the cooling of the labor market will actually help curb inflation a little bit because families and households are less likely to put dollars towards their discretionary spending budgets, and that will start to pull back, some prices as people spend less. So it's definitely a double-edged sword, but the market has proven strong, and I know there's a lot on AI growth we've seen, Paul, right? So
yeah,
talk about.
I want to touch on the Fed a little bit since we're talking about the economy. Fed has two mandates: to maintain full employment and also keep prices stable. And they're contradictory to each other. The tools that we have available to control prices are different than the tools that we want to use when we're trying to maintain full employment. Just today, we heard that the job numbers were actually better than expected. So is it possible that the labor market's starting to improve?
It looks like it is. Or at least it's better than where analysts are at, Nick. I know you've been sort of following the labor markets. What are your thoughts on that too?
Yeah, it's interesting when these numbers come out, right? And maybe there could be some discrepancies with the government shutdown still coming, around with the job market data. But it'll be interesting to look at that as we move forward and see what direction the job markets are going in, because from almost, the middle of last year, started to see cracks in the job market. It led to, the Fed having more of a reason to decrease the federal funds rate, right, to promote more employment. But with a higher, job market data coming out, maybe we see the Fed, make adjustments to their plan. It's going to be interesting to look at that over the next couple of months here.
And we've seen a divergence in the Fed, right? I mean, historically, we've seen a Fed that's been more unanimous, I'll say. But we've definitely seen some divergence in the past couple of meetings.
Yeah, it's been a, split vote, or, some of the Fed seats have said, hey, I do agree with rate cuts, or I don't agree with rate cuts. And, they were sort of giving their individual points as to why. So, I think that's probably a good thing that there's some debate going on, because it does show that they are definitely very aware of the situation at hand. And I think they've recognized that, while inflation wasn't necessarily their fault, they were late to the party to actually control it. So I think they're really trying to be very conscious about, how do we not make this mistake again of being too late or too soon, and managing it appropriately.
Yeah. Okay. So here's our GDP forecasts. Nick, your thoughts on what we're seeing in GDP? It looks a little soft in the beginning of the year, but maybe some acceleration in the second half.
Yeah, we're just looking at, GDP compared to last year. And of course, the orange bars there are the forecast. So it is a little lower than what we've been seeing in the past. Q4 of this year turned out to be a lot lower with that jobs data showing some cracks there. But we are looking at, some improvement into next year from this past quarter. I think a lot of that has to do with the One Big Beautiful Bill Act, spurring some growth within companies, and just continued strong support from the AI earning companies.
Yeah. And I do want to talk a little bit about, taxes. We're coming into tax season. Maybe a little bit of a plug if anybody's looking for help in preparing their tax return this year, please feel free to reach out. Tax season officially starts for us on January 12th, is when we see, the start of everything starting to get prepared and come in. So, but, a lot happened. I mean, I can't believe, looking back into 2025, how much really happened. So one of the things that did happen on July 4th was the signing of the One Big Beautiful Bill, which extended the tax cuts from the Tax Cuts and Jobs Act of 2017. You want to just maybe add a little insight onto where you see the One Big Beautiful Bill helping out some areas of economic growth?
Yeah, I mean, I think the extension, we were seeing, really, right, three possible scenarios, right, where the tax rates could revert back to where they were at higher rates pre-Tax Cuts and Jobs Act. They could be extended, or alternatively, there could be new tax code altogether. So, there was only a 1/3 chance that the tax law could be extended, and the low odds actually pull through, the underdog pull through on the odds, right? So if you were a gambling individual, then you definitely made money there. So, I think it was very positive for a lot of folks, because a lot of people have been really enjoying the high standard deduction, not worrying about itemizing as much, although that might change with the raise in the SALT caps. A lot of people were doing it for like retirement planning, about just managing income, Roth conversion opportunities. Businesses were taking full year deductions or full year depreciation on assets. So I think having that continuation will just continue to really fuel individuals and small businesses to take advantage of a lot of the tax benefits. And the OBBA has just expanded on that, additional deductions for seniors, regards to Social Security at different, income levels. And we're just seeing Congress be very favorable towards really I think a lot of middle class and lower income households on the tax side.
Yeah. Especially with the no tax on tips and overtime, that's gonna, provide a big savings for a lot of people.
Definitely.
Yeah.
So let's keep going here. And, we talked about inflation. And, Nick, we do see inflation, being curtailed, within the core CPE, but we still see services, on the higher side. Maybe your thoughts on what we're seeing with inflation and the combination between service inflation and consumer goods inflation.
Yeah, and inflation's been a little bit annoying over the past couple of years, right? So it's been a lot stickier than we really expected. I mean, we saw that peak in 2020, 2021 where it hit, 7-8%. Thankfully, it's come down since then, but it's still hanging around, around the 3-4% area.
Mhm.
And so how it relates to the services, we kind of have seen services inflation be a bit of a leading indicator for inflation number. And so with it increasing, by the tail end of this chart here, we could kind of glean from the past couple of years, maybe the core inflation follows that and ticks up a little bit more, which we don't love to see at this moment. But,
Right.
just from the look at the services and how it reacts or relates to core, you might see it tick up a little bit.
Yeah, and it definitely makes the work of the Fed a little bit harder.
Yeah.
When you see, the deviation between, both the CPI and the ISM. So, looking out, we are expecting, rates to continue to fall. I guess it's a question of how much, right, Ben?
Yeah, I know the Fed has planned 3 rate cuts for the year, right? And I feel like they always have these grandiose plans each year with their rate cuts, and then oftentimes we've seen more often than not that their plans to initiate a rate cut don't come to fruition. So, I have a little bit of skepticism whether or not we'll actually see 3 rate cuts, but it is good to see them trying to forecast and plan. I think while the labor numbers were better, right, than we were expecting, the job market overall is still softening. So I think that can really help support the Fed decision to say, we do really want to try to implement rate cuts. I would imagine that they'll want to do, small, more frequent bite-sized pieces if they can, like 25 basis points versus where it wasn't. We saw, the end of last year, or not 25, 24. I mean, they did that 50 basis points cut, which I think caught us a little bit by surprise too.
Yeah.
So I would imagine if they are going to do a rate cut, probably 25 basis points.
Right. And then we have a new Fed chair coming in May, right? So, we could see a completely different, policy on the table.
Sure.
So that is a little bit of a wild card, as it relates to interest rates. But the most important thing that I think, our clients look at is, what does it mean for me, right? All this is great. We talk a lot, but, what is it in it for me? And, we look at the housing market and how interest rates have really, had an impact on the housing market.
Yeah.
Nick, what are your thoughts when you look at, the 10-year treasury and interest rates and, people are locked in. I mean, I look at myself, my primary, my mortgage on my house is, I think like 2 3/4 or something like that. It's like, I've thought about moving, right? But, where am I going to go and how much is it going to increase my, cost of borrowing? So, what are your thoughts here?
Yeah, we don't see a lot of people moving out of their current rates right now because they are so advantageous, right? They're 2.5%. You go out, you have to get a new mortgage. You're looking at somewhere around 5 or 6%, right? So that does keep the supply low on the housing price on houses in general because people aren't leaving where they're going. And so it's an interesting dynamic where we sit right now. But I like this chart because it gives you a sense of how mortgage rates are kind of influenced by Fed actions or the market price of interest rates.
Yes.
Mortgage rates don't automatically come down when the Fed lowers interest rates. The Fed rate is more tied to the short-term interest rates, whereas mortgages are tied to the 10-year, which we see here. And the 10 years is influenced by market dynamics. It's how investors and everyone sees the market rate changing, not necessarily the Fed funds rate going down. So these two are really tied together, and it's a reason why we don't see a sharp drop in the mortgage rates right when the Fed decides to cut.
Yeah, and I mean I've heard different things. Ben, you may have some input on this as well, but I heard that when interest rates on the mortgage side get to around 5%, that's really going to open up the market. What kind of thoughts or reading have you done on that?
Yeah, I think so too, Paul. I mean, we have seen like real estate for existing homes, right? I mean, that market has been suffocated.
Mhm.
Like you said, Paul, like what person in their right mind would give up a 2.5% mortgage and
Mhm.
move, right? Because you're not going to find something existing. It's very difficult, or you're paying a premium
Mhm.
on that kind of property and foregoing inspections and all these crazy things, or you're looking at new construction. But a new construction is still expensive, A, and B, you're still going to be locking in a 6%, 6.5% 30-year mortgage. So, I definitely feel that once we start to see, and I don't think it's going to happen necessarily right away, but probably 6 months in around the summertime when we see the mortgage rates continue to fall and they break, under that 6% barrier that we've seen for a while now. I think more people will feel comfortable in saying, okay, is it a mortgage that I necessarily want? Maybe not, but is it something I can now afford and I can manage? And the answer is going to be, probably yes. And I think that'll start to release that suffocation that we've seen over these last few years of existing real estate.
Right. But there's a risk here too, and it's not talked about. I mean, it's not talked about really a lot, but I did want to bring it to the table. Right now, because of interest rates, the inventories are so low.
Right.
Right. So there's not a lot out there, which means that, if you're a seller, and you have a good property, chances are you're going to be able to get more money, just supply and demand.
Right.
Right. So once we see that inventory, I'll give you an example in Hillsdale. Literally, there's 4 houses for sale in the entire town, right? The entire town, and one of them has been on for sale for 2 years. It's a joke of a house, and the other 2 are pretty, high value. So you look at that, it's like, as soon as people want to start selling, and you have a flood of inventory coming out, I do sort of think that we're going to see some easing of the market values here, especially locally.
Yeah, sure. Yeah, I mean, I agree. I think housing prices they definitely won't continue to skyrocket like we've seen, and we might see some people selling or reducing their price. But I think even still, most sellers will still profit, but the profit margin just won't be as big, and that's definitely important planning considerations because most people rely on the proceeds of the sale of their primary house to buy another primary house.
Exactly.
And that can maybe limit their decision too. So.
Yep. Yeah, so the housing market will continue to be interesting as we see, those interest rates continue to fall. Let's just look globally here now on the economy. We are forecasting, about 2% GDP growth, which again, we're looking a little bit lighter in the beginning of the year with it picking up at the end of the year. But then we sort of, I don't want to say we missed it because we did open up on some of the emerging markets, but what are you seeing here when you look at this forecast?
Yeah, it's interesting, Paul, and I think really one of the biggest things that stands out to me is that, I mean, for several years we have been with clients and our market forecasts, we've just been saying, look, the place to be for equities is domestic, right? U.S. stocks. Last year, we started to see an opening with international. We started to introduce, even with our own strategies, the Eurozone and Asia. But emerging markets really appears to be like it's going to be a very opportunistic asset class because when you look, you see, the Eurozone, I hate to use this word, but it looks terrible compared to, the GDP growth compared to the U.S. Even the U.S. doesn't look, anything spectacular. And not to say that the U.S. or the Eurozone are out of favor or bad investments, just saying that, hey, in Asian countries and outside of Japan, really those emerging markets that we're seeing in Asia, those really could be some good growth opportunities or great diversifiers for, individual investors to start considering.
Yeah. I mean, one of the things that sort of jumped out at me was that, the United States, albeit, 2% is nothing, exciting from a economic growth standpoint. But when you look at the advanced economies versus the emerging markets, it definitely looks like, globally, and in the United States, we still have some areas. It's a matter of where you pick and choose from. And it looks like the Eurozone is going to continue to have some of their own issues as they've continued to struggle. You have some great economies out there and you have some that are just, really hurting, overseas. So, continue to watch that, but definitely some more opportunities than there has been, outside the United States.
Yeah, I think just real quick on this, it really shows the power of being diversified, right, in your portfolios. Because we have a lot of people that, see the S&P 500, see the returns it's been doing over the past 3 or 4 years.
Yep.
But I think now more than ever, there's areas outside of the US that it's worth kind of exploring and adding to portfolios.
Right.
Yeah.
Yeah, absolutely. I agree. So let's continue on to stock market here. Ben, we've looked at this, and we are in a current bull cycle here, getting into the fourth year. What are your thoughts when you sort of look at the stock market with the current 4-year cycle?
I think it's just good to sort of see historically of where we're at, right, Paul? I mean, if you look at the different bull markets where it's been at least 4 years or more, right, it hasn't happened that often, right? So there's 1, 2, 3, 4, 5, 8, right? 8 total cycles of 4-year bull markets or more in this chart. And when you look at it, right, the bright blue bar on the right of each of those 4 years, right, there's only been one time frame where the fourth year of a bull market actually was negative, and that was back in the
40s, right?
Which was a long time ago. So I think it's just more reassuring for investors to say, hey, because we've talked about it, right? We've said, we're seeing a slowdown of economic activity, a softening of the labor market, a turnover in Fed leadership. This creates a lot of question marks, but it doesn't mean that these are bad things per se, right? It just means that, hey, we might not see these crazy 20%, year over year returns, but we still expect them to be positive. And it's just, how do you position your portfolio in a way where you can take advantage of different opportunities to still achieve some nice growth without really limiting your exposure too much.
Yeah, and I think that's a great synopsis there. And I'm just going to add to it because, a couple of things that, we have to put on the table is, even though stocks, probably still have room to go, and that's based on, taxes and rate cuts, which we're going to show in a second. But, they are getting expensive, right? I mean, you look at, typically, and the reason why the blue bar in year one of most bull markets is it's usually a rebound, right? Stocks sold off so much that they become so cheap, right? And then they go up, and, everything has to catch up. So, when we transition over, stocks are not cheap, but, this chart here, which is interesting, is, we're looking at Fed cuts. And the different cycles that we're looking at is cuts with no recession, cuts with a recession, and then all cuts. And the teal line is really what we're living in, right? Because we're not in a recession. Typically, a lot of the times, when you enter a recession, the Fed will start cutting rates to try to spur economic growth. But that's not really where we're at right now. We're working within the teal range. And so, it looks like, between the tax cuts, rate cuts, and even though valuations may be a little bit high, there's a reason to, say that we're going to continue to have, some positive activity in the stock market for 25. Thoughts, either one?
Yeah, I think it's nice to see this because rate cuts from the Fed have been more of a luxury than a necessity, right? To your point, a lot of times the Fed needs to cut rates to kind of save the economy.
Right.
They're not doing that here. What they're doing is kind of looking to normalize the federal funds rate from its highs around 5 to maybe closer to 2 or 3%. And so just looking at history, again, history doesn't repeat itself as it rhymes, right? We have a good look at what history has done for cutting in terms of a luxury rather than a necessity here.
Okay. And so, part of that really has to do with how much is being spent, in capital expenditures. And I mean, I saw this, and this is, we got to talk about AI when we're talking about stocks. Yeah. Ben, tell us what's going on here.
This is like, I know you sort of look at it and you're just like, oh, it's just an upward, trending chart, but this is pretty crazy to see. I mean, this, a 40% compound, right, annual growth rate is nuts. And this just shows that, AI has become basically transformative of just how we live our daily lives and where companies are heading, right? If you compare this, we talked about this last year, Paul, where we said, is there an AI bubble? And the answer was, well, yes, it certainly percolated significantly compared to other asset classes, but it wasn't a bubble because it was justified, right? So many companies are pouring money into it. The supply is way below where demand is. I mean, the demand is astronomically high, and all these companies are trying to build more servers and just put more infrastructure in place to support the AI growth. And it's just crazy to see where you see these companies just pouring, hundreds of billions of dollars, and that number is gonna, within a few years, trickle over into the trillions of dollars of investment, into AI. So I think that's where we're really going to see a lot of where when we say, GDP is slowing, but we're still in the bull market, and AI is going to probably be the number one or at least top three contributor of why the market is still doing well.
Yeah, I mean, Nick, I'm going to ask for some of your thoughts on this as well. But the AI trade, as we call it, one of the biggest things that I know we always look at it with clients is, their saturation now, or I won't even say saturation. I'll say their overweightness in certain companies.
Yeah.
And, we're always now, peeling back that onion to try to see where, folks have exposure. And, we're showing 5 companies here, and it's not uncommon now for us to look at a portfolio, even diversified, where, those 5 companies represent 20-25% of their portfolios. Yeah.
Easily.
Right? And I mean, that to me scares the crap out of me.
Yeah.
Because I mean, to have, 25% of my money, unless I knew it, right? I mean, if I specifically went out and said, I want this, I want this, I want this.
Right.
But if I went out and I bought some mutual funds or some ETFs and I, thinking I'm diversified, but my whole portfolio's performance is based on 5 companies, scares me. What are your thoughts and takeaways?
Yeah, and when we talk to clients and when we, our values and where our morals land in portfolios is not to be too concentrated in one asset class or in one sector, just in case something does happen to that sector and it takes a large chunk out of your portfolio, out of your overall holdings.
Right.
So when things like AI hyperscalers and AI, chip makers kind of make up 30-40% of your portfolio, and the AI trade doesn't play out the way we expect it to. I mean, look, we have really high expectations for what AI is going to be able to do for growth of the companies and the stock market and just productivity in general and the growth of the economy. But if it doesn't play out to those high expectations, then you're kind of opening yourself up to necessary risks that you don't have to be super concentrated in.
Right.
So it does lend itself an opportunity to kind of, provide some rotation out of those stocks when you do have such a large investment already in those 7 or 8 stocks.
Yeah. Yep, absolutely. And, when we look at it in terms of earnings year over year, we're starting to see, the earnings of the Magnificent Seven starting to come down, even as their expenditures or their capital spending goes up. So that's going to be, an interesting play. But, we've been talking about somewhat of a sector rotation or having the other, 493 stocks participate. And, I think we're starting to see that. And I think we'll start to continue to see that, so, one of the things that, we talk about with clients is, if you're investing in index funds and those index funds are being reliant upon the dominance performance of those Mag 7, you may want to think about, having an allocation where you can have, more exposure to those 493 as opposed to the total 500. Ben, what are your thoughts around that?
Yeah, it's just like you said before, Paul, where, an investor, says, hey, this is what my portfolio is, and it's maybe 10 different mutual funds. And on paper, it feels like you're diversified. But when you peel back the onion, you often see cross-pollination of saying, okay, 7 of the 10 mutual funds all own NVIDIA. Right? I think NVIDIA has probably been the most common culprit of saying, you might own these 7 mutual funds, but NVIDIA is owned, at 1, 2, 3% clips across the board. And now 10% of your portfolio is NVIDIA, right? So I think that's really where it is just making sure that you have that understanding. And if this is something that you struggle with and you're not sure of how to do, this is where, having a financial planner can come in and really help there, to give ourselves a little bit of a plug, of course. But there's ways to create different portfolios of saying, okay, maybe I'll have just one large cap growth, ETF or mutual fund, or maybe I'll have a technology fund or a healthcare fund. And that's where you can start to parse out and not get over concentrated unintentionally just because it feels like you're diversified, but when in reality, you're really overweight or all your eggs are in one basket.
Yep. So I'm going to be excited to sort of see, some of that rotation come out there. Would it be an economic update without talking about elections?
Never.
We always try to show some data as it relates to elections. And so we have a chart up here. Blue is your average returns. Your orange or rust color there is your average maximum drawdown, meaning a negative performance. And then the volatility, right? How much volatility are we expecting to see? And I think the interesting thing here is that, we expect to have volatility except in the pre-election year of a president. So, Nick, you want to sort of talk about elections and midterms and what it means to clients?
Yeah. So this year, the midterm elections will be happening, and we see from the chart here that there is some volatility. A lot more volatility occurs during midterm years than the pre-election years, and even the first year in office and the last year, right? And for this year especially, there's always going to be uncertainty when it comes to mid-year elections. Yep. Because what's happening is, the president and Congress have to, be on the same page when they want to pass policy through. The majority is owned by both the president and the House of Representatives and the Senate. But with this year, it is a slim majority on the House side.
Razor thin. It's like 1 or 2 seats, really thin.
And even on the Senate side, it's about 3 or 4 seats. With policy being passed through with a lot on President Trump's agenda and us predicting that out, if the Republicans lose the majority, there's more uncertainty as to what is actually going to happen for the rest of the year. Right? Yep. So that's where we see, the midterm elections causing a little bit more volatility. But what tends to happen historically is after the midterm elections clear up, more things become known, there's more certainty, recovery starts to happen. And that's one of the big reasons the pre-election year, the year following the midterm election year, does have a large bounce back.
Yeah. And I will say this before we go into talking about fixed income and bonds, we do have, higher valuations in stocks. We do have some tailwinds coming, AI and the tax bill. And volatility is definitely going to be a certainty. So I think, taking away on the stock side, also understanding the volatility, I think we're going to see last year we had 1 month of volatility, April, May. That was it really. I mean, other than your normal here and there, I think 2026, having said everything about the equity markets, I would just want to reinforce that, probably will most likely be more of a volatile year than what we saw in 2025. All right. So, Ben, you want to kick us off with the bond market here?
All right. This is Jean's favorite, so I will try to live up to her expectations on this one. Gina's our bond queen for sure. All right. So we talked about this a little bit, right? Is that, the 10-year treasury is typically correlated to the expected, Fed funds rate, basically looking at this, right? We can see all the different yields at different points and then basically the chart, over where rates are at, right? So, all this is just saying that the Fed funds rate, along that dotted line at any given point, that's typically where we see most of the data off. And this just tells us that most of the time, the 10-year treasury is typically tied to where the Fed funds rate usually is, right? You can see a lot of those blue dots are 10-year treasury rates throughout history and just where it's actually tied to, with that dotted teal line there in the middle. So just gives us some sense of where bond rates are likely to be. And again, this is important because Nick did a great job before of saying, 10-year rates are also sort of the anchor to mortgage rates. So that'll be, it sort of trickles, right? Fed fund rates to 10-year rates to where the mortgage rates are going to be.
Yeah, and just continuing that theme. By the way, I love scatter plots. I don't know.
Yeah. Nice correlation line. Yeah.
So when we look at credit spreads, we're looking at the current spreads being below, which means that there's some room for performance improvement there. Some of this may have to do with the inverted yield curve that we were living with for so long.
Mm-hmm.
And so now that we are working with a more typical, normal yield curve, I think we're going to sort of see some of the spreads, come back in alignment. Any thoughts, either one or?
No, just that the credit spreads have gotten historically tight as of recent. And so we usually don't see them that
that tight. Yeah. So see what happens with the bond market here. But again, falling interest rates, inverse relationship. So, we should see a positive total return in the bond market, even with interest rates falling. We should see some of those prices, continuing to recover as those bond rates fall, as those interest rates fall. So, overall, I think the bond market is looking pretty healthy.
Yeah, I think that's on the next slide, Paul, is the rates. So,
There you go.
piggybacking off what Paul said, all this is for, I know there's a lot on the screen, right? So if you look at just these are the different bond indexes labeled on the left-hand side of the screen, each row. And then it gives us scenarios, right? So sort of the best case, which are the bull rate, this would be a reducing of 1% rates. What happens at a 0.5%, reduction of rates, no change, a raise in 0.5% of rates, or a raise in 1%. In a rate change, and that's the bear case, right? So obviously, current bond owners are probably going to be rooting for, the drop in rates. We can see really the biggest benefactors to the drop in rates are going to be sort of the total bond index, or more specifically the corporate bonds, which is where we've seen a lot of bond investors really flock to over the last few years is going to be high grade, high yielding bonds. And that's where those particular ones, owning a grade A bond yielding 6% is awesome. And if rates drop, that's just really going to skyrocket the value of those corporate bonds. And obviously on the bear side, right, this would be great for new investors looking to get into the bond space. For existing bond owners, this is really going to diminish any sort of appreciation pretty much across the board, outside of, a couple of categories, for bonds. So again, we're leaning more likely toward rates coming down, just as where the Fed is sitting, and that will likely be indicative of the rest of the bond market as a whole. But this just gives everyone sort of a sense of different scenarios, which I think is cool to see.
Yeah, it is. And I'll just, when I first saw this, I was, caught off guard for a minute, but we're looking at change in interest rates at the top, but the numbers, it represents a change in value. So,
Thank you for clarifying.
That's all right. I don't want people thinking that, interest rates are going up to 10% as interest rates are going down. So this is looking at, a change in value as it relates to interest rates. So showing that amongst the different asset classes. So, even with a 0.5 point rate cut, we're looking at some, decent returns there.
Yeah, it's interesting to compare this to your actual savings accounts too, because if you're parking money for short-term, goals and whatever it might be, beyond what you have for an emergency fund, if you have money that you want to have invested for kind of the shorter end of the time horizon, with a decreasing interest rate environment, like what we're expecting over the course of the year, your savings rate that you're going to be getting from any high yield accounts is going to go down. That's just a fact as the Fed kind of drops interest rates.
Mm-hmm.
But if the Fed were to drop interest rates, you have that appreciation that's inherent with bond accounts, where if they do drop rates, you're now owning a bond that has a higher payout than new issue bonds, so you're getting that appreciation there.
Yep.
So it's an interesting point and a good place to be if you are looking short term.
Yep, absolutely. So we'll just talk about M&A for a second, just a real quick second. And you guys can feel free to comment, but we put this in there just because, the investment banking world is, somewhat critical to the financial sector. And so we did see, deals start slowing down over the past couple of years, but then we've sort of, seen more deals and more bigger deals. And, if it happens this year, SpaceX is going to be probably a big, IPO that people look at. So, not a tremendous amount here, but, just this also shows a sign of a healthy economy. When companies feel the need to go out to the, public markets, as opposed to the private markets, it shows more confidence that there's more value in the public markets than the private markets. Any thoughts on, what we see going on with M&A here?
I think really for me, Paul, it's just sort of, a lot of the deals, mergers and acquisitions, right, are funded by capital, right? And if capital is expensive to obtain, right, especially with smaller businesses or medium-sized businesses, right? I mean, that's where their money's going to come from, is they're going to have to get a loan, right? And the interest rates have been incredibly high for businesses to get loans. So, I think that's just a positive sign that, access to capital is becoming more affordable, right? Which will help, again, sort of give some additional fueling to the economy and like you said, give just some public confidence back into consumer sentiment.
Yep. Awesome. Well, moving along here, commodities, we're talking about, obviously all commodities here, but the ones that, you can't help but to think of is gold and silver.
It felt like the gold rush all over
Yeah, exactly. And, we're going to talk about that, but, we're starting to see, some resistance within the sector. So before we, really get into some of the specifics, what do you guys want to sort of highlight with what you guys have seen going on within the commodities areas?
Yeah, I mean, you talked about it. The metals, right, are really the talk of the town right now. When we look at, the gold's return and silver's return compared to the S&P 500, it's really blown it out of the water this year. And I think the next chart will focus mainly on gold and why it's really outperformed. We've seen a lot of central banks go ahead and demand gold, go out and buy gold, and that's really driven up the price. So we'll see how that continues. But you can really see on the chart on the top is showing S&P 500 compared to gold in the blue, and how it's kind of reacted to some of these big geopolitical events. You see gold being a little bit of a geopolitical kind of hedge. And so you've seen that's really caused a lot of the performance this year.
Yeah. I have my own theory and philosophy when I see things like this. I call it the grandmother effect, right? Yeah. And that's when grandma, I look back through the last 30 years and, in 1999, grandma came in and wanted to buy tech stocks, right as there was a bubble forming, back in 2006, grandma wanted to buy, real estate. So there's always, these things that get so bent up with the news and everything else like that. But, there's a couple of things on this chart that are really significant to me. The one that I think supports the grandma effect is the orange ETF demand.
Yeah.
And, you can see, here, and the reason is because that's the easiest way for, the average person to get involved in, commodities.
Right.
So, when there was an oil boom years ago and grandma came in and wanted to buy oil, I was laughing and I was like, well, do you want a barrel delivered to your house? Like, how do you want to take possession of it?
Right.
And, gold is the same way. Gold is not an easy, way of owning a currency, right? I mean, because it comes in certain denominations. You're buying 1 ounce, bars or whatever you're buying, you got to store them. So there's a lot more to it around than just, so therefore the ETF is the easiest way. And I think when you see, these ETF, demand grow in these years is where, typically see years of, positive, movement in the market. And you can see here, we're starting to build, a lot of that ETF valuation. What are your thoughts as it relates? I understand the other and the central bank, but, any thoughts on that? ETF demand?
Yeah, and ETF demand, ETFs in general just have been on the rise and giving, investors a good alternative to mutual funds. But it also gives investors a good entry point into a lot of different, areas that can be invested in, whether it's, gold or Bitcoin. We've seen a lot of Bitcoin ETFs come out, silver,
Yep.
palladium, really anything, that has value and can appreciate is kind of turning into an ETF nowadays.
Yep.
But it has grown particularly by a lot here in the past year, which is really interesting to me.
Yeah, and it was really spurred, with the tariffs. I mean, the world uncertainty, people flock to something that they know is going to have or retain some value and
Yeah.
maybe a hedge against inflation. So, it was interesting to see the divergence between the S&P, and where we saw the gold, price per ounce. So, I guess my caution here is that, and I've seen it time and time again. I understand the value in commodities. I understand how they're used. I understand, the demand for them. But, when we start getting up into prices that are, where we are now, you have to sort of throw caution to the wind.
Yeah.
And see whether or not, now is the time, or do we want to wait for some softening in the market? Ben?
Yeah, I'm laughing at all the negative years from 2022 through 20. I mean, that's negative demand. And that means that people were literally selling their gold investments.
Yep.
People were dumping them in favor of something else. It's just funny, right? It's sort of like, for, I guess like my generation, right? Millennials, the credit effect. We saw like stocks like AMC.
Yeah, GameStop.
Yep, GameStop, where these meme stocks just sort of appeared out of nowhere, and there really wasn't much of a rhyme or reason for that, and they just blew up, and then they imploded, right? So, I'm not saying that that's going to happen with gold and silver necessarily, and of course, the trigger for this was a little bit different. Again, it was around tariffs and around just trade and currency uncertainty. So, there is some rationale to doing it, but it is funny to see, gold and silver become this like crazy hot topic almost overnight. People saying, I'm going to rush to buy gold. And even some clients reached out and said, do I own any gold in my portfolio, right?
Yeah.
Just everyone wanting to sort of get in on the action a little.
Yep.
So it's just funny.
Yeah. So, we're coming up to the top of the hour here. We can sit and see what questions we have, but as we do that, maybe we just go around the table and give our final thoughts as to, coming out of 2025 into 2026 and, final thoughts.
Yeah, I mean, everything we talked about today kind of leads itself to diversification, right? We're coming into the fourth year of a bull market, especially where stocks have done really well, domestic stocks. But in the stock sector, we could see some rotation from growth to more value side, but also from international to overseas. That could also be an opportunity in people's portfolios, even gold, right? Commodities, and just having a little bit of each sector, so you are able to participate in some of those gains of we've seen gold where it's outperformed the market by 50-60%. Right, so just having your portfolio in different sectors and the ability to profit off those.
Yeah, for me, guys, what I'm seeing is that 2026, I'm expecting it to be a slower year in terms of growth, but overall it still should be positive. I think there's going to be some speed bumps along the way with the midterm elections and different variables that we've sort of talked about, that we're seeing here, a slowdown in the labor markets, reduction of consumer discretionary spending. So it's going to be, I think, a good year, but also a challenging year for investors. I think investors are definitely going to need some additional support and guidance, and it makes me feel like I want to be extra diligent, and just helping people say, these are the asset classes that we really need to be focusing in on, even if they may not necessarily be at the forefront of what the media is saying, right? Because that's the easiest access of information, but really the best way to go about doing it.
Thanks for that. And, I think, looking out over my career and, the different markets that we've been through, there's always reminiscence of different times. And, every time is different, right? We always hear that, that there's never been, the same in the markets. But, I think, having the run up in, the Mag 7, is probably, to me, I don't necessarily think, we're in for a major correction of any means, but, I do think that, the softening of the market, especially with those 7 stocks, could be on the horizon. We saw it with earnings season this year. I'm sorry, this quarter, right? I mean, the earnings were good, but, they weren't as good as what they were in the prior. So, we started seeing it, at that point. The other thing too that I remember back at is, back in the late 90s, I mean, you could take a dart and throw it at the board and have it land on a stock and you made money.
Yeah.
Right. And that's how 2025 feels to me. It was like, you just took something and, threw it and you made money. It didn't matter. And, I think our memories are such short term. And my message really as we close up is that, just remember history. History does repeat itself if you don't learn from it.
Yeah.
And so, I just want people to understand that, as much as we enjoy, great years in the market, it doesn't mean that every year is going to be as great as the one that we just came out of. So, just seeing a quick question that came in here. About a market correction of greater than 10%. Look, I think we see that, in a month. Sometimes we saw 20% in April. So I don't even think that a correction anymore is 10%. I think that's just normal volatility. A correction to me would be, you lose the money, you lose the value and it stays there. That to me is a correction. So I don't necessarily think, we're in for a, sustained loss of 10%. But look, I mean, we've seen the markets go up 5, down 5 and up 5% in a day. So technology and electronic trading has definitely shifted. So yeah, I would definitely think that, volatility of 10% or more is on the table. But I don't think it's a sustained. I think, we're going to go through, as Ben said, some different bumps and bruises, but overall, I think the economy is healthy.
Yeah.
Stock prices are a little bit inflated, but again, we have the tailwinds of the AI trade, capital expenditure spending, the tax cuts, so and interest rates dropping. So we do have the recipe to support the valuations, and I think that's really what it's about. So I don't see a recession. I don't see a prolonged downturn in the market, but definitely volatility. So Nick.
Yeah.
Thanks for being here today, and congratulations on your recent success of passing the CFP.
Thank you.
So that's awesome. And Ben, always great having you.
Thanks, guys.
Your insights. And, we'll look forward to talking to everybody as we progress through tax time. Have a great day. Bye-bye.
Bye.